Welcome to today's session on history and methodology and economics. And the topic of today's talk is the revolution in macroeconomics in the 1970s, displacement of Keynesian economics, and the development of the equilibrium business cycle models that replaced the Keynesian models. Let me introduce the topic first. The 1970s, which we are talking about, were characterized by a gradual shift and movement from Keynesian interventionist policies to new policy mix, which has been later referred as a neoliberal policy mix based on limited state and little and limited state interventions into the economy. Moreover, rather than considering the unemployment and low economic activity as the main quest of the main challenges for the economy, in the center of the attention appeared inflation and the attempts to limit inflation were the most important paradigm and policy. Let's try it again. Welcome to today's session of History and Methodology in Economics. Today's talk is the revolution in macroeconomics of the 1970s, displacement of Keynesian economics, and the equilibrium business cycle models. Let me introduce the topic first. The 1970s are the times when the Keynesian interventionist policies were gradually abandoned and were replaced by a new policy mix, later referred as a neoliberal, with limited state, little state intervention, and with a shift of the policy priorities from achieving full employment into trying to combat inflation and achieving low and stable inflation, no matter what the cost in terms of unemployment will be. There's been also a shift in economics, in economic theory, from partial equilibrium models and behavioral models that were based on observed regularities observed in the data. We moved towards models based on general equilibrium in the spirit of our de Bruijn general equilibrium model and dynamic optimization that's been proposed by Robert Lucas and his followers. What do I mean by dynamic optimization and shift from static models or partial equilibrium models towards general equilibrium models? Consider, for example, the ISLM model. The IS curve is about an equilibrium on a goods market, while the LM curve is about the equilibrium on a money market. Those equilibria are supposed to be achieved individually, and then it is calculated where is the equilibrium of both market simultaneously, which is then supposed to be the equilibrium of the overall economy. However, labor market is not being present there explicitly, neither the decision-making of households and firms and other agents in the economy, such as the government, which decides there only about the size of government expenditures, but not about their composition, taxes, and so on. The general equilibrium models and dynamic general equilibrium models starts from the bottom. So they start with households, firms, perhaps government even, but mainly with households and firms, and they assume that households and firms have rational expectations and are able to optimize over time. So that's the dynamic optimization, that they do not optimize just within a given point of time, but over the whole time span. The methods are a bit beyond the aim and scope of the course, so won't go into it and left it for macroeconomic courses, but rather we talk about the implications of this shift, because the shift in economics changed the paradigm into such paradigm which remained until today as a core of today's macroeconomics, and the policy implications derived on these models shape the economic policy until today. What today's talk will be about, so the outline. In the prequel, we will talk about two keystones of this shift in policies. The first was monetarism and the contribution by Milton Friedman to economics. The second was public choice theory, which shifted the perspective on the state. Rather than seeing a state as a cure to economic problems, it started to be considered as a source of economic problems, because state failures are connected with larger participation of a state in the economy, and those state failures might be, according to the proponents of this theory, a much bigger problem than the market failures, which the interventions try to solve. Then we will discuss the revolution itself, the shift towards rational expectations model and equilibrium models of business cycles, and we'll talk about the implications. One of those is the policy and effectiveness hypothesis. And then we move to the first two generations or iterations of business cycle models. The first will be a monetary business cycle model by Robert Lucas, and the second will be the real business cycles theory by Kirtland and Prescott. And we'll finish this talk about an assessment of the theoretical shift of the 1970s and about the implications it has. Let me start with the Phillips curve. In fact, for a shift of a paradigm, what it needs to be done is that one needs to attack the key concept of the previous theoretical framework. And the key concept of the theoretical framework of the 50s and 60s was for sure the Phillips curve as an empirical trade-off between inflation and unemployment. This trade-off, although it has been just empirical, served as a guidance for economic policy. It's been very popular, and it's been widely believed that it holds, that even such a simple model is able to provide reliable predictions. So the Phillips curve and the attack on the Phillips curve served as an instrument how to destroy the belief in other underlying concepts of the old Keynesian consensus, filled with partial models. What's been considered as a problem of the Phillips curve? Suppose that we start first at a point E0 where we are at some kind of point where unemployment is relatively stable, there are no inflationary pressures, but the policymaker might decide, okay, perhaps my voters would prefer a bit lower unemployment and would consider slightly increased inflation as a lowest problem than the problem connected with such a high level of inflation we now have. The U star seems to be insufficient for him. So he might wish to move to a point E1. Why the E1 actually decreases the unemployment? What happens is the so-called money illusion. There's an increase in inflation, which decreases nominal wage, which decreases the real wages, which increases the nominal wages, but it's just because of inflation. So the real wages remain the same or even decrease. And because the real wages decrease, the firms firm became more profitable and everybody spends more, and it is assumed, at least implicitly, that no one is able to renegotiate the contract so quickly to adjust to a change in the inflation rate. However, what the proponents of the paradigm shift, and especially Milton Friedman and Edmund Phelps started with, they started to argue that, okay, but we won't stop in the point E1. What will happen is that we move to E2 because people will adjust their beliefs, and when they adjust their belief, they won't be willing to accept decreased real wages anymore. But when the real wages return, then the demand returns back to the original level, and we move to the point E2 here with the same unemployment as before, but with higher inflation. So the point E2 is clearly inferior in comparison to the point E0. So what Milton Friedman and Edmund Phelps started to argue is that the short-term Phillips curve is not the only one which we should care. The short-term interest Phillips curve is this is this inverse relationship, but the long-term Phillips curve is something what we should care about as well. And the long-term Phillips curve is actually vertical. The long-term Phillips curve implies that for many values of inflation might be consistent with just one value of unemployment. And the movements in unemployment above or beyond will just move the inflation upwards or downwards. This was quite revolutionary because it implied that the Phillips curve is no longer suitable for policy guidance. These ideas were first informally formulated by Milton Friedman in his presidential address at the annual meeting of the American Economic Association in 1967 and published in a journal in the subsequent year. The main topic of his talk was to summarize what the monetary policy can and cannot do. So 2 points towards the limits of monetary policy in general. He was very critical towards that time policymics, which put a main focus on fiscal policies and considered the long-term stable full employment as the main goal of economic policy, and used monetary policy as a purely technical instrument which should have kept the interest rates very low to hold down the interest payments by the government. That means to gradually increase money supply so that the equilibrium on the money market is achieved with relatively low interest rate. The argumentation by Milton Friedman was that such a policies with over and over increasing and gradual increase of a growth rate of money supply would inevitably lead to inflation, and that once those limits of monetary policy are being achieved, the only implication would be rise in inflation and higher rates of inflation, and the policy won't be able to to achieve low inflation and low unemployment anymore. What is actually interesting on his paper when seeing it from today's perspective is that he delivered his speech in 1968, where the inflation rate actually wasn't very large. Yeah, it was increasing for the past few years, for the past about 3 or 4 years, but it's been still at 4%, so it's been quite levels relatively comparable with levels during the mid-1950s, for example, and wasn't much higher. But the federal funds rate was gradually increasing, so it pointed somehow towards the limits that the monetary policy perhaps moved to limits and was no longer able to to eliminate the inflationary pressures in the economy. And also the unemployment rate was very low. Both were the consequences of the military expenditures associated with the Vietnam War. And also the GDP growth looks, after small cooling of the economy in the late of 1960s, relatively fine. However, if we just turn our attention to the later developments from into the 1970s, we see that the times changed very quickly. Already at the beginning of the 1970s, the GDP growth went quickly into recession, unemployment increased, and in the next subsequent recessions and expansions, the unemployment never returned to the levels where it was in the second half of 1960s. It returned there actually at the end of 1990s first. So it took really a lot of years to achieve similar levels of unemployment as they were in the 1960s. Moreover, the inflation with the red color here was gradually increasing. So we saw not only there were those fast increases associated with oil shocks, but there's been even a trend inflation increasing. So something which was inconsistent with the Phillips curve. There's been upward sloping trend in unemployment, and there's been also upward sloping trend in inflation rate. Similarly, Milton Friedman correctly predicted that the spikes in inflation would be preceded by large large increases in money supply growth. So this is what you can observe here with the brown color. And he also pointed out in his speech that that the interest rates would most likely be increasing because the policy won't be able to achieve low inflation with moderate levels of interest rate. So the biggest success of Friedman's speech was that he was able to predict correctly what will happen in the very near future. Let me have a look also, let me turn your attention also to the development of the Phillips Curve relationship. Here on this plot, you can see a cross-sectional plot between inflation and unemployment rate. The observations at given points of times are just linked together with to represent how the relationship evolved over time. And what we can see is that for most of the period, it seems that the unemployment-inflation relationship was very close to something that was Phillips curve, just one Phillips curve. However, when we move to 1970s and 1980s, we see completely different picture where we cannot observe any trace of Phillips curve anymore. Maybe here, with some degree of fantasy, and maybe also here, and maybe also here, but then we have here a lot of shifts, and we see that the relationship is far from being deterministic, and it is very hard to use the Phillips curve for policy guidance after seeing this picture and after seeing the development in 1970s and in 1980s. Here, just for making the picture, for completing the picture, is the Phillips curve relationship, how it evolved from 1950s till 2015, and you can see that the movements were very often somewhere here in this area with relatively modest inflation and many different unemployment rates. But then we had here periods with high inflation and high unemployment rate, or with the low inflation and high unemployment rate. Still, it's hard to identify here just one Phillips curve that could be exploited by policymaking. So the trade-off was gone, and different tools were needed, different models were needed to provide policy guidance. The second key component of the shift of the theoretical framework of economics in the 1970s was the public choice theory. It's just a very limited and little field in economics, but it has really strong consequences for accepting policies which preferred limited role of the state. In particular, the failure of the Keynesian policies in the late of 1960s and in the 1970s appeared in times of very rising distrust towards the states. There has been the Vietnam War, the protest of 1968, and also the Watergate affair in the 1970s. So it's been quite appealing to think about, to accept the theoretical implications of the theory, which are that the state is a problem, not just the market failures are a problem. The basic assumption or basic argument of the public choice theory is that governments and bureaucrats shouldn't be considered as an actor in the economy that improves the welfare, that automatically contributes to stabilization of the economy. Rather, policymakers are also selfish, as the consumers or firms are in classical economics are quite selfish, and they are driven by their self-interest. So they might exploit any opportunities for maximization of their profits and their electoral gain, no matter what are the implications for the aggregate economy, according to public choice theory. So as long as their interests are in line with the interests of the economy, it might be fine. But when they feel that there is no conflict, or that their interest might be different, then unless seeking, for example, for re-election, they just try to, or are prone to rent-seeking, corruption, and simply not being efficient. They call this government failures, and they argue that government failures might be much more harmful than market failures. And additionally, the market failures, which are simply inevitable, they just happen in capitalist economies. But the state failures can be prevented by limiting the role of the state. So the public choice theory, developed especially by James Buchanan, Gordon Tullock, Mansur Olson, and William Niskanen, set the ground for accepting the economic theories which would work with which would imply that limited role of the state is actually something desirable, what we might be willing to achieve.